Good day, I'm Victor Mupunga, Head of Research at Old Mutual Wealth Private Clients. Our assessment of the budget that was presented by the Finance Minister is that on the whole, the budget has more positives than negatives. Given that 2024 is an election year, the fear or the risk going into the budget was that you could see some populist measures being introduced. However, there weren't any of those in this budget. Secondly, from an expectation perspective, it's fair to say that this budget came in ahead of expectations. Granted, when you compare the 2024 budget to the 2023 budget, there has been a deterioration in the fiscal outlook of the country. However, if you think back to where we were towards the end of 2023, particularly around the medium-term policy statement, the expectation there was for a much weaker budget than what we saw now. So from an expectations perspective, the budget was better than what was expected. In terms of the direct impact that the budget has on your portfolio, it's probably useful to think about it from three perspectives. Firstly, from a fixed income perspective, an equity perspective, and then from a currency perspective. Just starting with the fixed income or the bond aspect of one's portfolio. This is the part of the portfolio that tends to be most impacted by the budget, because during the budget, the minister gives some guidance in terms of the bond issuance or bond supply looking forward. As far as that's concerned, the budget was very positive. Treasury insisted on their fiscal consolidation path. We are not going to see a large supply of bonds going forward, which is a positive for the bond market and for the bond aspect of one's portfolio. From an equity perspective, however, we view the budget as being neutral. On one hand, the minister did not adjust the tax brackets, as is usually done in the past, to cater for inflation, which would be a negative. However, on the other hand, ensuring that Treasury sticks to the path of fiscal consolidation ensures that lowers the cost of capital, which is one of the key drivers for valuations for our equities. So from an equity perspective, we'd probably say that the budget was balanced. And then lastly, from a currency perspective, the immediate reaction of the currency market, or the rand specifically, to the budget was a strengthening. However, this just takes us back to the level that we were at earlier in the month. One cannot ignore the long-term trend that we've seen of the rand weakening against most developed market currencies. However, looked at as a whole, we think that the budget speaks to the need for one to have a diversified portfolio. From the fixed income perspective, one is able to benefit from the high yields that are present in the local market, which is something that was confirmed by the bond market as a reaction to the budget statement. From an equity perspective, we did not see anything in the budget that suggests that we're going to see an acceleration in growth, which would compel individuals to diversify, or rather to not diversify their equity exposure, both globally and locally. And then from a currency perspective, again, it speaks to the need for one to be diversified across different geographies. So in summary, we thought this was a budget that had more positives than negatives, more positive for the bond market, neutral for the equity market, but long-term speaks to the need for one to have a diversified portfolio. Thank you.